Leverage ratios measure how much debt a company has compared to something like its equity or its cash flow. Debt is great because it can help a company grow faster, but high debt can also mean higher risk. With debt comes interest repayments, and if you can't pay your interest, you may be forced into bankruptcy. As a stock investor, you will want to calculate leverage ratios to determine if a company is potentially over-leveraged. Our first leverage ratio is the debt-to-equity ratio. The debt-to-equity ratio compares a company's debt to its shareholder equity. If you look up the debt-to-equity ratio, you will find two ways to calculate it. The first way is to add up all a company's debt. That's the short-term debt, the long-term debt, and any other debt-like items, such as leases. Here is a list of items the Corporate Finance Institute considers debt. We then divide the total debt by total shareholder equity. The second way people calculate the debt-to-equity ratio is to take total liabilities and divide it by total shareholder equity. I prefer the first way because not all liabilities are debts. Think of it like this. In your household, you use electricity. Every few months, you get a bill. While the bill is something you owe, making it a liability, it's not a debt. With a debt, you usually have to pay interest. Your debts might include your mortgage or your credit card balance. Whichever method you use, it's important that it remains consistent across companies. To calculate the debt-to-equity ratio, we'll need the balance sheet. Here is an example balance sheet. Let's calculate the debt-to-equity ratio. The debt-to-equity ratio equals total debt divided by total shareholder equity. The only items considered debt on this balance sheet are the long-term debt. Long-term debt is 710. That makes our total debt 710. Total shareholder equity is 810. 710 divided by 810 equals 0.88. A debt-to-equity ratio of 0.88 means the company has 88 cents of debt for every dollar of shareholder equity. A good debt-to-equity ratio will depend on the industry the company is a part of. Banks make their money from debt, so their debt-to-equity ratio will be much higher than other types of companies. Some people like debt-to-equity ratios of 0.5 or less, meaning the company has twice as much equity as debt. Others like a debt-to-equity ratio of less than 1, meaning debt is not more than equity. Personally, I start with companies with debt-to-equity ratios of less than 1. I prefer companies with lower debt-to-equity ratios than higher ones. Companies that have consistent cash flows usually don't take on too much debt. That's because they can fund their growth internally. Our next leverage ratio is the interest coverage ratio. If you have debt, you must pay interest to the lender. The interest coverage ratio tells you if a company can pay its interest expense, or how many times it could pay its interest expense. To calculate the interest coverage ratio, we take the operating profit and divide it by the interest expense. Let's calculate the interest coverage ratio. Our operating profit is $800. Our interest expense is $50. 800 divided by 50 equals 16. This means the company can pay its interest expense 16 times. The higher the interest coverage ratio, the better. I look for companies with interest coverage ratios that are greater than the industry median. Again, companies that generate consistent cash flows usually have high interest coverage ratios. That's because 1, they don't take on too much debt, so they don't have to pay much interest, and 2, they generate lots of operating profit. Our last leverage ratio is the debt to free cash flow. It tells you how many years it would take the company to pay off its debt if it directed all its free cash flow to paying off debt. To calculate the debt to free cash flow ratio, we divide total debt by free cash flow. Our total debt is 710. We need to calculate our free cash flow. Free cash flow equals cash from operating activities minus purchase of property, plant and equipment. Cash from operating activities is 625. Purchase of property, plant and equipment is 100. 625 minus 100 equals 525. Our debt to free cash flow is 710 divided by 525, which equals 1.35. That means it would take this company 1.35 years to pay off its debt with its free cash flow. When analyzing the debt to free cash flow ratios of companies, the smaller the better. I tend to look for companies with debt to free cash flows of 3 or less. You can probably guess that companies with consistent cash flows tend to have low debt to free cash flow ratios. 1, because they don't take on debt, and 2, because they generate lots of cash. Let's calculate these leverage ratios for Nike. Here we have Nike's 10K for the 2023 financial year. Here we have Nike's balance sheet as of 31 May 2023. To calculate Nike's debt to equity ratio, we need their total debt and their total shareholder equity. If we look through the liabilities, we can find the items that are debt. Remember, these numbers are in millions of dollars. First, we have current portion of long-term debt. It was 0. Next, we have notes payable. It was 6. Next is current portion of operating lease liabilities. It was 425. Next is long-term debt of 8,927. And operating lease liabilities was 2,786. If we add these all up, we get the total debt of 12,144. Total shareholder equity was 14,004. 12,144 divided by 14,004 equals 0.87. Nike's debt to equity ratio as of 31 of May 2023 was 0.87. For every dollar of equity, Nike has 87 cents of debt. Now let's do the interest coverage ratio. It equals operating profit divided by interest expense. Operating profit is usually on the income statement. Here we have Nike's income statement, but Nike hasn't separated operating profit for us. To calculate it, we subtract total selling and admin expense from gross profit. Gross profit was $22,292. Total selling and admin expense was $16,377. $22,292 minus $16,377 equals $5,915. The income statement shows the net interest expense, or income, which means it takes the interest earned and subtracts the interest paid. The net interest earned was $6 million. Nike earned more from interest than it paid, but we just want the interest paid. To find this, you might need to do some digging. A tip is to hit Ctrl F to do a text search and search for interest expense. In the notes, I found that Nike had an interest income of $297 million. The net interest income was $6 million. I can work out the interest expense by subtracting the net interest income from the interest income. $297 million in interest income minus the $6 million in net interest gives us the interest expense of $291 million. Nike's interest coverage ratio is 5,915 divided by 291, which is 20.33. Nike can cover its interest expense 20 times. If a company has a positive operating profit and a net interest income and not a net interest expense, I usually won't bother calculating the interest coverage ratio because there's essentially no interest that needs covering. Lastly, let's calculate the debt to free cash flow ratio. For that, we need total debt and free cash flow. We already calculated total debt. It was $12,144. To calculate free cash flow, we subtract additions to property, plant and equipment from cash provided by operations. Cash provided by operations was $5,841. Additions to property, plant and equipment was $969. $5,841 minus $969 equals $4,872. Nike's debt to free cash flow is $12,144 divided by $4,872, which equals 2.49. This means Nike could pay off its debt within 2.49 years if it used all its free cash flow to repay debt. While leverage can be used to help fund the business, it also adds additional risk. Leverage ratios help you determine if a company has too much debt. In this video, we learnt about the debt to equity ratio, the interest coverage ratio, and the debt to free cash flow ratio. In the next video, we'll cover turnover ratios. These tell you how efficiently a company can manage its inventory, collect payments from customers, and pay its suppliers. To be notified when that video comes out, hit the subscribe button. If you want more videos like this, hit the like button and leave a comment on any video topics you'd like me to cover. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.